Hello and welcome back to Explain the Charts. Today is October 19th, 2025, and we are doing an in-depth analysis of the Australian dollar versus the US dollar, or AUDUSD. The fundamental picture for the Aussie dollar is looking increasingly bearish, and the headlines are painting a clear picture of why. First, we're seeing a significant escalation in US-China trade tensions, with threats of 100% tariffs from the US in response to China's potential limits on rare earth exports. As Australia's economy is closely tied to China, any friction here directly weighs on the Aussie dollar. Compounding this issue is weak domestic data coming out of Australia. The latest jobs report for September was a disappointment, showing a smaller increase in jobs than expected and an unemployment rate jumping to a near four-year high of 4.5%. This has dramatically shifted market expectations, with the probability of a November rate cut from the Reserve Bank of Australia now sitting at a staggering 85%. Furthermore, weak inflation data from China is adding to concerns about slowing global growth, which hurts risk-sensitive currencies like the AUD. While the US dollar has shown some weakness itself due to a government shutdown and expectations for Fed rate cuts, it hasn't been enough to offset the overwhelming negative sentiment surrounding the Australian economy. Analysts are now calling for bears to target the 0.6400 level, with key resistance forming around the 0.6520 to 0.6540 area. Now, let's see how this dramatic news is reflected in the charts. Looking at the daily chart, the long-term trend is undeniably bearish. We can see a clear downtrend that has been in place for over a year, with a major peak established back in late September of 2024 near the 0.69 level. Since then, the price has formed a series of lower highs and lower lows, indicating persistent selling pressure. There have been several sharp, high-volume declines, notably the drop on October 4, 2024, and another significant leg down in late November. The price found a bottom and went through a period of extreme volatility in late 2024 and early 2025, with long wicks showing tests of levels well below 0.60. After a brief recovery earlier this year, the downtrend has resumed, which perfectly aligns with the negative fundamental news we just discussed. The price is currently trading around 0.649, which is a critical juncture after the recent sell-off. Let's zoom in on the more recent price action since the beginning of August. Here we can more clearly see the recent downtrend accelerating. After failing to hold above 0.66 in early October, the price experienced a sharp drop on October 10th. That large red candle took us from above 0.656 down to a low near 0.646, slicing through several potential support levels. This move was a strong confirmation of the bearish sentiment we've been hearing about in the news. Following that drop, the price has entered a period of consolidation over the last week. This sideways movement suggests the market is pausing to digest the recent losses and is waiting for the next catalyst. This could be a bear flag pattern, which would suggest another move to the downside is likely. The ceiling of this consolidation is right around that 0.6520 level mentioned in the news, which has acted as firm resistance. On the downside, the low of this range is around 0.6470, which is our immediate support. Now, let's drill down to the 15-minute chart to analyze the very latest price action from the past few days. This intraday view confirms the consolidation pattern we saw on the daily chart. We can see the market has been trading in a very tight range, mostly between 0.6480 and 0.6510. The price has repeatedly tested the upper boundary near 0.651 but has failed to break through, showing that sellers are active at this level. Similarly, buyers have been defending the 0.6480 area, preventing a further slide for now. This type of range-bound activity is typical before a major news event or a significant breakout. For day traders, this range provides clear levels to trade against. A clean break and hold below 0.6470 would be a strong bearish signal on this time frame. Conversely, a sustained move above 0.6520 would be required to suggest any short-term bullish momentum. However, given the broader context, any upward moves are likely to be met with selling pressure. So, let's put it all together and recap the key takeaways. Switching back to our daily chart, the big picture remains overwhelmingly bearish, supported by both the technical trend and the fundamental news. The primary drivers are the expectations of an RBA rate cut, weak Australian and Chinese economic data, and renewed US-China trade tensions. Our key price levels to watch are critical. Immediate support sits at 0.6470. A break below this level is highly probable and would open the door to the next support at 0.6445, followed by the major bearish target of 0.6400. To the upside, significant resistance lies at the 0.6520 to 0.6540 zone. It would take a decisive break above this area to challenge the bearish outlook, and even then, further resistance waits near 0.6600. Given the current fundamentals, the bearish scenario of a break below 0.6470 seems most likely. I'd place the probability at around 75%. This would be reinforced by a poor Australian jobs report or any further negative headlines regarding trade. A bullish scenario, requiring a break above 0.6540, feels much less likely at around 25% and would need a significant, unexpected positive catalyst. Keep a close eye on the upcoming RBA minutes and jobs data, as they will be pivotal for the next major move in August. And finally, a brief disclaimer. This video is for informational and educational purposes only and should not be considered financial advice. Trading involves risk, and you should always conduct your own research and due diligence before making any investment decisions. Thank you for watching Explain the Charts, and we'll see you in the next analysis.